Open your 401k app right now. Look at that number staring back at you. That number is supposed to tell you something important, whether you are safe or whether you are behind. Here is the uncomfortable truth. That number has been lying to almost everyone who looks at it. Not because it is fake. The balance is real. It is lying because of what it does not show you and what it lets you assume. Welcome back to The Wealth Metrics. Real numbers, no noise. Today, we are breaking down 6 myths about your retirement balance. Myths that keep people either falsely confident or needlessly terrified. By the end of this video, you will look at your own balance completely differently. Not with more fear, with more clarity. If you have ever closed this app fast because the number scared you, you are not alone. Stick around, because myth number 1 is probably the exact reason you felt that way. Let us start with the myth almost everyone believes first, the one about averages. Myth number 1. If your balance matches the average for your age, you are fine. Here is what the average actually looks like right now. According to Vanguard's How America Saves 2026 report, the average 401k balance at the end of 2025 was $167,970. Sounds decent, right? Now here's the number nobody puts in the headline. The median balance, the one that represents what a typical saver actually has, was just $44,115. Read that gap again. The average is nearly 4 times higher than the median. That is not a small rounding difference. That is a completely different picture of reality. Why the gap? Because averages get pulled upward by a small group of very high balances. Think of it like this. If 9 people in a room have $10,000 each, and one person has $10 million, the average in that room looks like $1 million. But 9 out of 10 people in that room are nowhere close to $1 million. The average lied to all of them. Your 401k statistics work exactly the same way. A small percentage of long-tenured, high-income super savers pull the average far above what most people actually hold. The median is the more honest number. It tells you where the person in the exact middle actually stands. And if you are near the median for your age, you are not behind. You are literally in the middle of the pack. This single distinction, average versus median, is probably the most misunderstood number in personal finance. And it is the first lie your balance tells you. Myth number 2. A 6-figure balance means you are financially secure. Here is the problem with that assumption. A balance is a number on a screen. Security depends on what that number can actually buy. According to Empower's 2026 analysis, the average 401k balance across all ages is $340,364. That number sounds like real wealth. But Fidelity's own guidance suggests you need about 10 times your annual salary saved by age 67 just to retire comfortably. For someone earning $70,000 a year, that is $700,000. A balance that looked impressive in isolation suddenly looks like less than half of what is actually needed. The number did not shrink. Your understanding of it just got corrected. This is why a balance without context is not information. It is just a feeling. And feelings are exactly what fuel the anxiety we see everywhere right now. According to Northwestern Mutual's 2026 study, Americans now believe they need $1.46 million to retire comfortably. That number climbed by $200,000 in a single year. Not because people suddenly want a fancier retirement. It climbed because inflation, rising healthcare costs, and longer life expectancy keep pushing the real target further away. The balance stays flat while the target moves. Here is the part that matters. Almost half of Americans, 48%, now believe it is somewhat or very likely they will outlive their own savings. That is not a small worry at the edges. That is nearly half the country doubting the number in their own account. So no, a big balance by itself does not mean you are secure. Security comes from knowing what that balance needs to cover, for how many years, against what costs. Here is a quick gut check. If your balance ever made you feel proud one month and panicked the next, the balance never changed that fast. Your comparison point did. Most people are quietly comparing themselves to a headline number that was never built to represent them in the first place. That single habit causes more unnecessary anxiety than the actual state of most people's finances. Now let us move to a benchmark that sounds more personalized and find out if it holds up any better. Myth number 3. If you match Fidelity's age-based benchmark, you are officially on track. Fidelity's well-known guideline says you should have 1 times your salary saved by age 30, 3 times by 40, 6 times by 50, 8 times by 60, and 10 times by age 67. These multiples are built on a set of assumptions: a certain savings rate, a certain retirement age, a certain investment return, a certain life expectancy. Change any one of those assumptions and the multiple changes with it. Someone planning to retire at 60 in an expensive city needs a completely different multiple than someone retiring at 68 somewhere with a lower cost of living. This is the danger of treating a benchmark like a finish line. A benchmark is a rough compass, not a guaranteed destination. Here is real data on where people currently stand against that compass. According to Fidelity's own Q2 2026 figures, millennials hold an average 401k balance of $82,600. Gen X, the generation now closest to retirement, holds an average of $215,600. Baby boomers hold an average of $260,300. Compare those numbers to the multiples Fidelity itself recommends, and a gap appears for most people. That gap is not a personal failure. It reflects real structural pressure. Stagnant wage growth relative to living costs, rising healthcare expenses, and a shift away from pensions that used to guarantee income regardless of market performance. According to Newsweek's coverage of the Northwestern Mutual study, 1 in 5 Gen X respondents said financial hardship has already forced them to delay retirement. That is the highest of any generation surveyed. So if your number does not match the benchmark, you are not broken. You are one of the majority of people navigating a genuinely harder savings environment than previous generations faced. The benchmark is a tool for direction, not a verdict on your worth or your discipline. Use it to course correct, not to spiral. Now here is a myth that sounds less like an opinion and more like a guarantee, which makes it the most dangerous one on this list. Myth number 4. The 4% rule guarantees your money will last through retirement. The 4% rule has been repeated so many times, it sounds like a law of physics. Withdraw 4% of your balance each year, and, in theory, your money lasts about 30 years. Here is what most people never hear about that rule. It is a historical estimate, not a guarantee. It assumes a fairly balanced portfolio and market conditions similar to past decades. Markets do not always cooperate with assumptions. According to MetLife's 2026 research, pre-retirees now expect their savings to last an average of only 15 years after retirement. That is down from 19 years, just 4 years earlier. At the same time, many of those same people expect to actually spend 25 to 30 years in retirement. That gap between expectation and reality is where anxiety lives. 58% of pre-retirees close to retirement age say they worry about running out of money in their retirement plan. Half of retirees who still have savings left say they share that exact same fear. This is not a fringe worry. This is the majority experience among people at the edge of retirement right now. Part of the issue is something called sequence of returns risk. If the market drops significantly in your first few years of withdrawals, your balance can take damage. It never fully recovers from, even if the market bounces back later. The 4% rule was never designed to account for the exact timing of a downturn hitting your specific retirement date. It is a rule of thumb dressed up as a guarantee. This does not mean the rule is useless. It means it should be treated as a starting estimate, not a promise carved in stone. Myth number 5. Your balance today tells you exactly what your life will look like in retirement. This might be the most misleading myth of all, because it treats a snapshot like a forecast. Your balance today is a photograph taken on one specific day. According to the investment company Institute, total 401k assets actually fell to $9.9 trillion by the end of March 2026, down from $10.1 trillion at the end of 2025. That drop happened purely because of market movement, not because millions of people suddenly stopped saving. Fidelity reported something similar. The average balance in their plans dipped 4% in the first quarter of 2026, even while the total savings rate hit a record 14.4%. Read that combination carefully. People were saving more than ever, and their balances still went down. That single fact should permanently change how you interpret your own number. A dip in your balance does not necessarily mean you're doing something wrong. Your balance on any single day is mostly noise. Your savings rate over years is signal. And confusing the two is exactly what causes people to panic sell or stop contributing altogether. Myth number 6. There is a safety net waiting to fill whatever gap your savings leave behind. This is a sensitive topic, so let us stick strictly to the data here. According to the 2026 Retirement Confidence Survey from EBRI and Greenwald Research, retirement confidence has dropped to its lowest level since 2017. 61% of workers say they feel confident about having enough money for a comfortable retirement. That is down 6 percentage points from the year before. A significant share of both workers and retirees say they are uncertain about the future value of external retirement support systems. This uncertainty itself, regardless of how it eventually resolves, is a real source of stress that financial planning has to account for. The healthy response to uncertainty is not panic, and it is not blind faith either. It is building your own plan so that it does not depend entirely on assumptions outside your control. Whatever happens with any external program, the portion of your retirement that you personally fund and control remains yours. That is the part worth focusing your energy on. 6 myths down. Now let us talk about what actually predicts your future, because it is simpler than any of this. 3 things matter far more than your balance on any given day: your savings rate, your consistency, and your time in the market. Your savings rate is the percentage of your income you are putting away, including whatever your employer matches. According to Vanguard, the general target is 12 to 15% of income between you and your employer combined. In 2025, 51% of Vanguard participants either hit that target or maxed out their contribution limit. That is up from 47% just 4 years earlier. That trend is genuinely encouraging. More people are building the habit that actually matters, regardless of what the balance shows on any particular day. Consistency is the second piece. A dip during a bad market quarter means nothing if you kept contributing through it. Historically, the people who kept contributing steadily through downturns ended up buying more shares at lower prices. That consistency is invisible in a single balance check, but it compounds enormously over decades. Time in the market is the third piece, and it is the one most people underestimate. Starting 5 years earlier, even with smaller contributions, often outperforms starting later with larger ones. This is simply how compound growth works. Money that has been invested longer has had more time for its own gains to generate further gains. Here is a way to reframe your relationship with that number starting today. Stop asking, "Is this balance big enough right now?" Start asking, "Is my savings rate moving in the right direction? And have I stayed consistent through the ups and downs?" Those two questions predict your future far better than any single snapshot. If you have been avoiding your 401k app because the number scares you, that avoidance is actually the more dangerous habit, not the number itself. People who disengage from their accounts during downturns often miss the recovery entirely. The ones who stayed engaged and kept contributing were the ones who benefited when the market turned back upward. So, open the app. Not to judge yourself against a distorted average, but to check one thing: your contribution rate. Let us also address the emotional side of this, because retirement anxiety is real and it deserves to be named honestly. According to Schroders' 2026 survey, 58% of current retirees say they do not know how long their savings will actually last. 64% wish they had done more planning before they retired. That regret is not really about a specific dollar figure. It is about clarity, or the lack of it. People who understood their numbers early tend to feel more in control, even when their balance is modest. People who avoided looking at their numbers tend to feel more anxious, even when their balance is objectively solid. Clarity, not size, is what determines how secure you actually feel. Every myth we busted today caused either false confidence or false despair. Both push people toward the same mistake, making decisions based on a number they never actually understood. The antidote to both is the same thing: understanding what your balance can and cannot tell you. Think about your own balance right now, whatever it is. If you just compared it to a national average, forget that comparison. It was probably distorted by outliers who do not represent your reality at all. If you are worried because the balance dropped recently, remember that market movement is normal and largely temporary. What matters is whether you kept contributing through it. And if you are anxious about factors outside your control, focus your energy on the portion you can actually influence: your rate, your consistency, your time horizon. That reframe alone will change how you feel every time you open that app. Not because the number changed, because your understanding of the number did. This channel exists for exactly this reason: to take the numbers everyone throws around and show you what they actually mean for your life. No fear-mongering, no unrealistic promises, just the real data broken down clearly. That is what real numbers, no noise, actually means. If this video changed how you look at your own balance, that is worth more than any single number on a screen. Understanding beats anxiety every single time. Before you go, here is one action step. Open your 401k account today and check one number only: your current contribution percentage, not the balance, the contribution rate. If it is below 12 to 15% combined with your employer match, consider raising it by even 1% this month. That small adjustment compounds enormously over the coming decades. Small, consistent action beats occasional panic every single time. That is not a myth. That is simply how compounding works. If you found this useful, subscribe to the Wealth Metrics for more breakdowns like this one: debt, savings, investing, and the retirement numbers that actually matter. Drop a comment with your biggest takeaway from today. It helps us know what to break down next. And if you know someone who checks their balance and immediately spirals, send this video their way. They deserve the real picture, not just the scary number. Thanks for watching The Wealth Metrics. Real numbers, no noise, and a lot less anxiety than the headlines want you to feel.